Hello, and welcome to Alternative Angles, a Fidelity podcast where we hear from fund managers, analysts, and traders who make investment decisions in complex alternative strategies. I'm Steve Rosen, and I'm your host. If you're unfamiliar with the expression, remember Archimedes, don't you worry, you are not alone. It's just a wisecrack made by my 88-year-old father when he observed someone attempting to lift something heavy. My dad refers, of course, to the ancient Greek physicist and engineer who, among many things, mathematically proved the power of a lever, and famously said, "Give me a fulcrum on which to stand, and I will move the earth." My father's quip and that Archimedes quote came to mind as I was thinking about this episode on opportunistic and distressed debt investing. It's a high-stakes discipline in which practitioners attempt to capture upside from mispriced credit, often by identifying the fulcrum security in a company's capital structure, buying in at a low price amidst market uncertainty, and then, depending upon the circumstance, using negotiating leverage to maximize the return. To explain the strategy and the tactics behind it, I'm joined today by three Fidelity experts. Harley Lank is the portfolio manager of Fidelity's opportunistic and distressed debt strategies, and he's the head of the company's high income and alternatives division. And here with Harley are special situations managing directors and strategy co-portfolio managers, Nate Van Duzer and Bill Wall. Harley, Nate, and Bill each have decades of experience in the asset class, and they work closely together with their team of analysts and traders to find inefficiencies and unlock value in stressed and distressed credit. Harley, Nate, Bill, thanks for breaking away from choppy markets. Welcome to Alternative Angles. And before we get into today's topic, I'd like each of you to introduce yourselves to our listeners by catching them up on your career path to the present, which might be a challenge to distill down to 60 seconds, but let's give it a try. Harley, let's start with you.
Great. Well, outside of working fry machines at Wendy's or digging ditches, most of my career has actually been spent in leveraged finance. And believe it or not, it was pretty intentional. How I got here, I think, was really just a function of what was happening in the world during what I'd consider to be my formative professional years. I witnessed the rise and fall of Drexel Burnham and Michael Milken, who really spawned the use of high-yield bonds. They were junk bonds back then, to finance corporate raiders, hostile takeovers, leveraged buyouts. The drama behind these stories filled the Wall Street Journal, and I thought it was pretty captivating. But what really caught my attention was that I came to realize that there was a consistent theme with these targeted companies in that they were massively undervalued. And I realized that these were the types of companies that I wanted to analyze. So coming out of business school, I joined the high yield group at Fidelity. And it was truly my dream job, not just because they're the largest player in the market, but having grown up in Massachusetts, Fidelity was actually my hometown favorite. And I've been here for nearly 30 years, the last 25 or so as a portfolio manager, looking for these inefficiencies and undervalued investment opportunities.
Great. Nate, why don't you pick up?
Sure, thanks. After college, I was a construction engineer in the Army, where I blew things up and built things, which actually turned out to be good training for the current job that I have. After law school, I joined a big firm here in Boston, met a really smart guy named Bill Wall, and have stayed connected in one way or another with him for close to 30 years. I joined Fidelity in 2001, initially as a lawyer, and after a few years, transitioned into the role that I have now, which is working on various distressed opportunities, doing restructurings, both domestic and overseas as occasion requires, and really just enjoyed the breadth of skills, intelligence, the opportunities we have working at such a premier firm, and every day is a little different. We work on a lot of different type of deals across many industries. It keeps us on our toes for sure.
And Bill, how about you?
Sure. So if we're reaching back, I'll say that after college, I started my career as a janitor for a short period and started to enjoy cleaning up messes. And so not much has changed since then. Spent a few more years in the State House working for the House of Representatives and the budget stuff. And if you want to see sharp practices, spend some time in politics and policymaking. But so trained me well to go on to law school, joined a firm in Boston, as Nate mentioned, and clerked for a federal judge. And then I was fortunate enough to join Fidelity in '96, shortly after Harley did. Worked on distressed investments and restructurings for a while, and then ended up helping to form the bank loan group, which has become one of our shining stars. Then I moved over to do some private equity work. So I have had a fair degree of experience with alternatives at Fidelity, but not having had enough, I decided to go off to the hedge fund world, made a big mistake career-wise and left Fidelity, and spent many years at a couple of hedge funds in Boston. And that was great, good fun, but was fortunate enough to be reunited with Harley and Nate, and spent the last 5 years working with them on a variety of restructurings and workouts. And now we're putting money together in this alternative asset class that we so dearly love, distressed investing, credit opportunities.
Thanks for those introductions. You all have a great depth and breadth of experience, and I'm looking forward to an informative discussion. Now, as I look through my list of questions, the first few seem well suited to you, Harley. And to kick things off, I think we should establish an upfront baseline by defining terms within the investment purview that we're about to talk about. So, Harley, what is opportunistic credit investing? And is it the same as distressed debt investing, or is it different?
I think if you ask 10 sophisticated investors what opportunistic credit investing means, you'll get 12 different answers. I think about it pretty simplistically, though. We're looking for high returns, equity-like returns, by investing in debt instruments that are misunderstood or undervalued based on our fundamental views. Distressed debt, I actually view as a subset of opportunistic credit investing. And even this takes on different meanings depending upon who you ask, but generally I'll describe it as debt that's issued by a company that's either in bankruptcy or highly likely to go through a bankruptcy or restructuring process. The market itself has a broader or more formulaic definition, and that's any debt that yields 10% or more over the risk-free treasury rate. So in other words, if treasuries are at 4%, if a bond is yielding 14.5%, the market would define that as distressed debt. I do want to take the opportunity, though, to make an important point on how Fidelity approaches this strategy versus others. Historically, this style of investing, particularly distressed, had some pretty colorfully grim monikers: vulture investing, grave dancing. At Fidelity, we're not going into a situation looking to rip a company apart. We're always going to fight to protect our investment, but more often than not, we're actually looking at ways to provide solutions for companies. We're looking to help them fix their balance sheets, either by providing freshly needed capital to give them some time and space to execute a turnaround, or helping them navigate through the complexities of fixing a balance sheet through a formal bankruptcy process. So beyond this distressed debt investing, we're also doing other types of investing. So there are lots of examples of us providing rescue capital for companies, again, giving them fresh capital to prevent that bankruptcy or restructuring, or what's commonly known as pull to par. An example of that would be where we're buying debt at, let's say, 70 cents on the dollar, with the belief that the company's debt is eventually going to trade back to par based on our differentiated fundamental view of the company.
Okay, and so with that approach and philosophy as a backdrop, give us a little more on your approach, and then also from an investment rationale point of view, the benefits and the risks of the strategy.
Let me start by saying this is an absolute return strategy. Generally speaking, we're targeting at least mid-teens IRRs on our investments. So above all else, a core principle that we have is we're going to be really disciplined with our investors' capital. So what that means is if we don't see the investments that can generate that type of return expectation, or more importantly, if we have to take on excessive risk or be overly speculative to get those types of returns, we're just not going to invest. So everything we do for this strategy is based on rigorous bottom-up fundamental research and analysis with a long-term perspective. So we're looking for those investment opportunities that present compelling upside given the fundamental risks that we see going forward. And the philosophy here is really rooted in leveraging our competitive advantage. The resources that we have here as part of the broader Fidelity is really incredible. We have an army of research professionals around the globe across all asset classes that are providing us real-time insights. It gives us an incredible flow of information, access to management teams. But perhaps even more importantly than that is our army of specialized analysts in our high income and credit alts division, which gives us not only a breadth of investment opportunities, which means we can be highly selective, but the depth of knowledge that they bring to these often complex stories is really second to none. And then, of course, I do want to highlight that sourcing these investments, too, is a competitive advantage that we have with our trading desks, our capital solutions capabilities that come into play. I could go on and on with all the tools and support functions that we get, but I'd say not many players in the field can offer this type of a comprehensive set of capabilities and resources with the strategy. You had asked about the rationale for some of the benefits or some of the risks that are involved in the strategy. Again, it's a total return strategy. So as investors think about asset allocation, they should really think about this type of an investment as going into their high risk, high return bucket. What makes the strategy so appealing is just the diversification benefits that it gives to investors without really having to give up that high return potential. So when things are not going well in the stock market, that tends to be a really good time for our opportunity set. And it's not always the case, but I'd say it's pretty often the case that a lot of the returns come through very company-specific catalysts, which may not be tied to the performance of the broader market. There are risks with this. With any high return strategy, you have to absorb some risks. And plain and simply, we can just get the fundamentals wrong. Just like investing in a stock, the future's uncertain. Things may not play out like we expect. Another risk is in the workout process itself, especially if we're going through the bankruptcy courts. There's plenty of precedents and rules of law that guide our decisions, but there's still an element of uncertainty as to how the process itself plays out. And finally, there's illiquidity risk that you have to deal with as part of this investment.
So you say you have a pretty incredible team that helps you. You talked about how they can identify idiosyncratic risks as you attempt to achieve equity-like returns. But it's also the case that the likelihood of finding mispriced loans and bonds increases during periods of uncertainty. Talk to us about the signals that you follow and observe, suggesting that there could be an opportunity at hand.
Look, Steve, I wish we had a screen that flashes red that tells us you need to be buying now. But the fact of the matter is that's not the case, and that's what makes this opportunity set so inefficient. The opportunities always exist, right? Just for some context, we tend to invest across a roughly $1.5 trillion high yield marketplace, a $1.5 trillion leveraged loan marketplace, plus opportunities in convertible bonds, preferred stock, even private credit. And we're talking about thousands of issuers here. So sometimes the opportunity sets are broad-based. So if there's an economic slowdown or there's high volatility in the marketplace, that'll impact a wide swath of industries and companies. Sometimes it may be industry specific. An industry could be going through secular or cyclical challenges. And there's always the idiosyncratic company specific issues that you just mentioned, right? Companies could just have too much debt. They made a bad acquisition, changes in the regulatory environment, whatever the case may be. Remember, we're talking about highly leveraged companies, so the margin of fundamental error here is pretty slim. The signals that we're looking for in all instances are heavily reliant on that rigorous fundamental research and analysis that we do, really as an ordinary course of business. Our investment professionals are tracking all the leading indicators that are specific signals of the future fundamental direction for their companies, and they differ, frankly, industry by industry. So as they start to deteriorate, that may help us avoid costly credit mistakes. But on the flip side, if things look to be bottoming or inflecting positively that we think are not yet necessarily reflected in security prices, that might be a buy signal. But the art here is understanding the specific challenges a company may be facing, determining what we think ultimately the business is worth based on our fundamental views, and then figuring out which part of the capital structure presents the best buying opportunity. Oftentimes that fulcrum security that you referenced in your introductory comments.
Let's say whether it's you or Bill or Nate or together and with your team, you identify an attractive opportunity, and then you go forward and you make an investment by buying a loan or a bond, and that means somebody else sold it to you. So my question is, if the go-forward return is so appealing, why didn't that seller hold on rather than transact?
So that's the rub, Steve. The vast majority of the vast majority of the debt that we invest in is actually traded over the counter. So what that means is there's real friction costs in trading, even in the most liquid, healthy names. And at the same time, there's also less Wall Street coverage, generally speaking, versus a typical public equity issuer. So that combination makes our markets less efficient than the equity markets. Now think about the scenario where there's dislocation or a company is undergoing real financial distress. That tends to bring out all types of sellers. So there are certain funds that by mandate can't hold a defaulted security. So when it looks like the probability of default is pretty high, you get certain funds that have to sell. Then you have other groups of investors that just don't have the expertise, they don't have the resources like a Bill or a Nate to go through a restructuring. And as the two of them can attest, it takes a lot of work and a lot of expertise to drive favorable outcomes through a restructuring process. There's other investors that may see value, but they just don't want to wait 1 to 2 years for the payoff. And then, of course, human nature kicks in a lot of instances where there's just fear and capitulation. And there's another interesting dynamic that overlays all this selling pressure, and that is when a company's going through financial distress, they tend to be very inwardly focused. And most of these management teams or the boards haven't gone through a potential restructuring. They have a bunch of advisors in the boardroom, maybe lobbying for them to go through a financial restructuring. And so they're very inwardly focused. The last thing they want to do is field phone calls from 200 anxious investors wanting to know what's going on with the company. So there's an information vacuum at a time of peak uncertainty for investors. And so, of course, the more uncertainty there is, the higher the return requirement, which translates into lower prices. So you get this wave of selling. You have no natural buyers who are ready to step into the abyss. And the simple laws of supply and demand come into play, where these inefficiencies get magnified, driving prices to extreme lows and sometimes way too low. If you understand the situation, if you know the industry, if you have the right product with patient capital, you can step in and really generate outsized returns for your investors.
And it's funny, Harley, it's Bill. I think that the willingness to step in front of the speeding train as it's heading downhill is not in everybody's constitution. And so it's a situation where you actually have to be contrarian. You have to think differently. We're able to have the willingness to go in and buy when others are selling rapidly and at lower prices, and in turn have the patience to work it out and to make money for investors. So it's very much a contrarian strategy. It's one that when the markets are in turmoil or in trouble, it's one where we can step up and identify opportunities given all of the work done by our star team of analysts and traders, and to be able to identify it and jump in and buy and not be unwilling to take the risk of holding it with illiquidity for a while to realize the return that we see ultimately coming through.
Hey, Bill, given what you just said and Harley said about the opportunity set, I want to stick with you for a second and tell me, given that on the one hand, Fidelity offers mutual funds and ETFs that are in an open-ended format, but in contrast, for your strategies, you've chosen a drawdown structure. Presumably, you think it's best for the strategy and the way to capitalize on the opportunity set that you guys just laid out. So tell us, how does that drawdown fund structure facilitate your entry and exit from the market for the benefit of your investors?
Sure. And for investors who aren't familiar with drawdown structures, basically it means you buy into a limited partnership. And when the manager deems it appropriate, the manager will call capital from you. That means you have to fund your commitment or a portion of your commitment. And the key word there is portion, because the virtue of the strategy is that we don't draw it down all at once. We don't call all of your money all at once. What we do is we wait for the opportunities to be identified. And then we feel like there's enough opportunities in the market. It makes sense to call capital and put it to work. We'll call in advance of the opportunities as well, because we want to be prepared to be able to act quickly. So a drawdown fund allows us to be both patient and opportunistic and act quickly when we need to, but it doesn't tie up folks' money when things aren't interesting. And so therefore, it's a multi-year commitment. It's a finite life to the fund, but during that period, your money is called and invested and reinvested in these opportunities. And so it's a very efficient way to make sure your money's earning as much as we think is possible and prudent during the life cycle of the fund. And then when the life cycle of the fund is over, you get your money back, however much or little we're able to make of it. Hopefully lots, but there's always risk to the downside.
Hey, Nate, I want to get you into the conversation. Bill had mentioned risks and volatility, and heretofore I've noticed that the number of corporate bankruptcies has been benign for a while, running at about half that of the last peak during the GFC. But it's also arguably the case that formal filings are suppressed by so-called liability management exercises, or LMEs. So tell us, what are LMEs? How have they come about? What are the different types? And how do they play into your strategy?
Liability management exercises is a broad term used to describe when a company addresses its funded debt on its balance sheet, the liabilities that it has. And we've seen really a proliferation of these kind of transactions in a variety of different shapes and styles. 25 years ago, a company would get into trouble. It might call up its lenders and say, it's time to organize. Let's try to figure out how to work this out. And we'll affect it through maybe a bankruptcy, either prepackaged bankruptcy or a full-on bankruptcy. But Harley mentioned earlier that court proceedings, court processes are uncertain. They're expensive. There's not one judge that presides over every bankruptcy in the United States. Every jurisdiction has its own set of judges, rules, procedures. And in a way to try to get more certainty and also avoid the really high costs of a bankruptcy proceeding and the risk of even losing control if you're an owner, what has happened in the last 5 years is sponsors primarily have looked at their balance sheets and said, if we've got debt that is trading at a discount to where it was issued, and we've got flexibility in the covenants that control that debt, is there a way that we can recut the debt, ask our existing lenders to potentially take a haircut, move assets out and borrow against those assets, even if it harms existing lenders? What are all the options we have under our documents that allow us to either reduce debt, extend the duration of that debt in such a way as to increase the option value or the equity value to the sponsors? And so what we've seen is just a whole host of these liability management exchanges get done. A lot of them done in the United States. Some are being done over in Europe. It's a process by which your existing credit or bond documents get reshuffled and restacked. So led to some litigation. All of them haven't worked. In fact, sometimes, decent amount of the time, companies still do end up in bankruptcy because you haven't fixed the underlying problem with the company. You've just restacked where the debt resides. It is a fact of life, though, that we're seeing a lot more of these liability management exercises, and we're seeing that the full-on bankruptcies. So how we approach it at Fidelity, one, we need to understand all the covenants in the documents underlying the credits that we're participating in. Finding out where the holes are, what the flexibilities might be, understanding also who owns the company, how aggressive they might be, and really being on our front foot with the advisors that work on a lot of these. Bill and I and Harley, we talk to folks that are doing LMEs all the time. We try to stay up on the latest technology. We really work with other creditors to position ourselves in the best possible way that if one of these exchanges comes, we're able to take advantage of it in a way that benefits our shareholders. And in some cases, we actually are involved early on in structuring how some of these are going to look.
Okay. Seems like there's a lot to think about there. A lot of opportunity can be created. And earlier, Harley, you had mentioned the resources that you bring to bear. But at a high level, maybe the three of you could get a little more granular and tell us about the differences and perhaps the advantages from your point of view of the resources that your approach and your group brings to this market. Harley, why don't you kick it off?
Why don't I start by highlighting the scale of our platform as part of the broader Fidelity? So Fidelity has close to 1,000 investment professionals around the globe. Last year alone in 2024, that means the nearly 1,000 investment professionals had over 18,000 company touch points and generated over 40,000 proprietary research notes. Those unique insights into what's happening fundamentally across industries and globally really helps us paint a broad mosaic when we're trying to assess a pretty challenging situation that a company or an industry may be going through. But beyond that, our 100 plus investment professionals in our group alone covers over 85% of the investable universe. And what that means is we can be highly selective in where we're looking to invest, above and beyond just having the depth of understanding as to what's going on through this particular situation. Our size and reputation, I think, are also huge differentiators. We have the ability to invest significant additional capital as part of a solution to a struggling company. And I think our reputation as a firm that takes a long-term view of its investments and cares deeply about its reputation in the marketplace, importantly, allows us to take a leadership role in driving these successful outcomes in complex situations. I don't know, Nate, Bill, maybe the two of you can talk more about that.
Great. I'll go next. Bill and I sat down and looked at all the different restructurings we've worked on over the years, and it's close to 400 across almost every industry imaginable. And there are some similarities that evolve out of that. In the early 2000s, it was telecom, then it was the airlines, the great financial crisis. A lot of companies and a lot of industries were affected by that. Recently, it's been oil and gas. On and on it goes. And there's some lessons that you can learn whenever there's a cycle for a particular industry that you can then apply to the next time you're investing in that space. This is a complex area. I think that the message is coming through in this podcast. This isn't just buying a stock and hoping it goes up. Really understanding the documentation, the dynamics of an industry, the trends that have been going on, and both how debt's been financed and if it's been worked out. We feel like we really have a differentiating skill set there, just given how many deals and for how long we've worked on them here at Fidelity.
And I'd add to that one of the virtues of what we have is that we work alongside a brilliant team of portfolio managers as well, who manage a number of different retail mutual funds in separate accounts that are invested in high yield bonds and loans. And they're in the market every day. And so working with them, they're constantly evaluating and investing in situations. And when it comes time where a company's in trouble, they're up to speed, the analysts are up to speed, and we can piggyback on that knowledge in addition to what we understand about the situation. And in turn, we can buy a position in our fund that, accompanied with what the other funds that we manage in our group have, means that we're a big player at the table, that people have to pay attention to our opinions, our preferences, and our views on how things should play out. And so that gives us a competitive edge that a small firm, and there's a lot of top quality small firms in the distressed and credit opportunity space, but they just can't match the resources we bring to bear, as well as the talent and experience. And so when we identify these situations, it's all hands on deck, evaluating it, and then working the bone for a while until we come up with a result for our funds and shareholders and investors.
All right, great. Hey, Bill and Nate, given all your special situations experience, I think it would be great to help our listeners better understand the totality of the investment process, and you could certainly crystallize it for them by going through a couple of examples that described how you perhaps identified the fulcrum opportunity, the questions you thought about as you did your due diligence, and the tactics you employed to effectuate a favorable outcome for your investors. Maybe Nate, why don't you go ahead?
Yeah, I'll start with a name that I think most people have heard of. The restructuring happened a few years ago, but it's a great example of the different skills that we have and really the complexity of some of these situations. The company's Six Flags, and it had been a new management team had come in, a new board had come in, and we're making some changes on the pricing that had a detrimental effect on profitability. They also suffered from some extraneous events like SARS. Katrina came in, wiped out the New Orleans theme park, and they just had too much debt. We owned some debt in the bank debt, and we also owned some of what's called the OpCo notes. And we'd worked with the company. The company had hired advisors. They said we had a maturity coming up. We're not going to be able to pay it off. We'd like to sit down and talk to our creditors. And the company's approach, driven by the chairman of the board, was let's figure out a way to recut the debt stack, but I want to stay in control. I like to keep all of my equity. I'd like you creditors to take a haircut, extend out your maturity, but I really like owning the business. We looked at it and said, just based on the valuation and how much debt you have, we don't see how it really makes much sense for the shareholders to stay in control. There's just not enough value to leak all the way up to the shareholders. And so we were involved in a pre-filing negotiation representing a group of OpCo bondholders with the company. We ultimately were not successful in reaching a deal. And much to our surprise, when the talks broke off, they filed the company and said, oh, and actually we're going to give most of the value is going to go to the banks. And if you want OpCo creditors, if you want to have any kind of recovery, you got to go fight with the banks over the new debt stack and the ownership. And so what we had to do was we actually had to find a new management team. We had to put together a complete business plan. We had to do a road show, went around and met with revolving lenders to see who would help finance our new business plan. And we also had to commit among ourselves to raise something like $400 million to deleverage the business. All this while we were fighting against the company who was trying to keep us from getting information about their business plan. And they were trying to preserve the plan that they had because it was so beneficial to the existing board and the shareholders. We even went so far as to not only identify the new management team, but also interview and completely fill a new board of directors. And on the eve of the confirmation hearing, where we went into the court and we said, we've got this great plan all ready to go. We're going to take control of the company. And I should pause right here. Shortly after the bankruptcy filing, as we were sitting down as a team figuring out where we thought the fulcrum security was, we identified this one bond, and Harley and his funds went out and bought a significant amount of that debt at about 60 cents on the dollar. 9 months later, we're ready to bring the company out of bankruptcy. We've gotten all the work done. We've gotten the documents ready to go. The holders of the holdco debt, which was another layer removed from the assets, stood up in court and said, we like exactly what they've done, but we've raised $900 million to pay down the banks and their tranche of debt, and we want to take control ourselves. As you know, as a creditor, you're only entitled to your par claim plus accrued, and in this case, a make-whole. So we were actually cashed out by this other group that was even further out of the money, but they believed in the company and paid us off. And the investment that Harley made at 60 cents on the dollar ended up 9 months later being paid off at 126 cents because it included accrued interest and the make-whole claim. So that was an example of really recreating an entire company, restacking all the debt, paying down some bank lenders. It was a lot of work, and ultimately we ended up not owning the company, got paid off. But it was just an example of how much has to go into these very complex situations when you have multiple stacks of debt and interested parties fighting against each other. And we thought it was a really good result.
Well, seems like a complex situation, a bit of a roller coaster ride, no pun intended, but a very favorable outcome. Hey, Bill, how about you? What have you worked on?
Sure. So a name that I think just about everybody's heard of is Hertz, the car rental company. And we've all waited in those long lines after a long day of travel at the airport picking up a car. And that's been a feature of the car rental business for a while. But there was a certain point in 2020 when the pandemic arose where those lines evaporated, and Hertz, which had thousands and thousands of cars waiting for customers, had no customers. And so what happens when that occurs is that revenue plummets. We owned some of the loans of the company, sold those off at a decent price, but we started to do some research on it. And one of our analysts spent a lot of time researching the leisure and business travel markets in the spring and summer of 2020. As you imagine, that didn't take a lot of work because there wasn't much happening. But we also realized that there was going to be, with everybody stuck at home and folks starting to come up for air a little bit, so to speak, that demand for at least leisure travel was coming back. As we were doing the research, it became evident that that was the case. Hertz filed for bankruptcy because it borrows a lot of money to buy its cars, and the folks who lent that money to them wanted to get paid back and force the sale of the cars. The other thing our analyst focused on was that used car prices were starting to go up. Initially, they went down because nobody was buying anything, but then they started to go up. And meanwhile, the company's securities, in particular the unsecured bonds, were trading at very distressed levels. What had been issued at par just a year or two before was now trading in the 20s and 30s. And so the analyst put us what we call a strong buy one on the name in the spring and summer of 2020, and Harley and other portfolio managers here at Fidelity bought a whole bunch of those bonds, and that gave us a seat at the table. At that point, game on. The company began to recover a bit financially, but still had a tremendous amount of debt, and ended up filing for bankruptcy because it owed that money to the lenders under what's called the asset-backed securities for the car loans that they had secured. So the company filed for bankruptcy and needed money. We offered financing for the company in bankruptcy and kept competing with others to do so. And then we also offered financing for the European business. They accepted that. Meanwhile, it became apparent that this was going to come down to a battle as to who would own the company on bankruptcy emergence. We had negotiations. We were part of what's called the steering committee. We had negotiations with several private equity firms that wanted to come in and recapitalize the company and take it out of bankruptcy. They had very different strategies. And so we ended up negotiating with them. Part of that negotiation is how will our bonds be treated. Part of it is what's their go forward plan and how much money do they need. We ended up partnering with one group of private equity firms and ended up creating an auction process for the company in bankruptcy court that resulted in an all-night bankruptcy, literally a brawl at one point with some folks shoving and pushing and maybe throwing a punch or two, but we didn't do any of that, but others did. And so ultimately the auction went on overnight, on, and we kept going back and forth bidding to try to win the auction. But at a certain point, given the historical practices of the industry, the competitive nature of the industry, the cost of capital and the amount of capital required, we sort of hit a limit as to what we thought the company was truly going to be worth. And so we said, as Nate said, in the case of Six Flags, we'll just take our bond payment and go home. So we went from the mid 20s and 30s, recovered all the way up to par, and then had a battle over the interest and won that as well. And so the winners in this case were the other private equity firms that were competing against us. So we'll see how that plays out for them. But for us, it was showing good discipline, incredibly deep and insightful research efforts, and the willingness to buy when everybody else was terrified of owning travel-related businesses in the pandemic in the summer of 2020.
Steve, what doesn't come through in these case studies is really the incredible leadership that Bill and Nate demonstrate in bringing these really challenging negotiations and situations to closure. So there's a lot of value add through the process itself, and the two of them don't necessarily get fair shake in terms of people understanding just the value that's added through the process and through their leadership. Not easy.
Yeah, no, it sounds like there's a ton going on to effectuate a favorable outcome. I certainly have renewed and greater appreciation for all of the work that they're doing, both at a high level and in the trenches. So, Harley, I want to get close to wrapping it up, and we heard about Six Flags, the amusement park business, Hertz rental cars. I'm curious, are there certain industries that have presented opportunities that you look to invest in, or are there others that you view skeptically?
The answer is yes.
Okay.
As a high yield investor, I think you have to view all industries skeptically. Our default line of questioning really starts with what can go wrong here. But in highly stressed situations, we do need to pay close attention to what can go right. And after 3 decades of doing this, I think one thing that I've learned is to never say never. A few examples from the past for me would be prior to the global financial crisis, I sort of had a hardline stance about not wanting to invest in high yield financial companies that are focused on lending, right? It's a net interest margin business. And by definition, if you're a high yield company, your cost of capital is higher, which means that these companies need to take on more risk to earn a competitive return. So it's only a matter of time before the credit cycle turns and their business model doesn't sustain itself. But the GFC actually presented some incredible buying opportunities in names like Ford Motor Credit or Ally Financial, formerly known as GMAC, because the world changed, balance sheet philosophies changed with a lot of these companies, and it taught me to really keep an open mind. Where it gets more challenging is we do tend to see a lot of industries that are in secular decline, the metaphorical melting ice cube. Those are tougher investments because they require a greater margin of safety, because ultimately we may not be able to determine what the terminal value of the business is and how quickly that time may come. But at the right price, you can make a lot of money in some of these situations. And so for me, there was an extreme example, I'll date myself, from a few decades ago where we made an investment in the paging industry. Some investors may even be Googling what the paging industry is at this point. But back then it was an industry in rapid decline because it was becoming technologically obsolete from the ubiquity of cell phone service coverage. But we looked at it and said, there's a core base of subscribers that need this mission critical service. And there was actually a company who was buying up its competitors and generating massive operating synergies by consolidating their networks. And we were able to step in and buy the business, buy the company's equity at 2 times free cash flow. And as a result, we were able to double our money pretty quickly there. So I'll never say never. There's plenty of opportunities now and in the future, and we're looking across all the industries.
So it sounds like you have to be open-minded and nimble, right? To capture opportunities that may come that in the past you may have felt weren't opportune, but times change.
Yep, exactly.
I guess my last question then, and I'll direct it to you, Harley, is just, what's your outlook? Do you have anything else to add?
I'm not sure compliance will let me provide a specific outlook. And as we speak, we're actually in the middle of some pretty severe market volatility tied to the trade wars. So anything I say may be rendered outdated based on how things progress anyways by the time people are listening to this. But I will provide some food for thought for our listeners. And that is, in many instances, the capital structures of these highly leveraged companies that we're looking at may have made sense or were at least manageable 4 or 5 years ago in a low interest rate environment. But in a higher for longer interest rate world, even if a company's quantum of debt is the same, the interest expense for most of these companies has gone up because they have some mixture of floating rate debt. And over time, they're going to need to refinance their lower coupon fixed rate debt into higher coupon debt. So it may be the case that the same level of debt is no longer sustainable. And what I'll share with listeners is looking at the leveraged loan universe. Again, it's a $1.5 trillion some odd large opportunity set for us, highly characterized by a lot of floating rate interest expense. But at the end of February of this year, nearly 50% of the companies in that leveraged loan universe had interest coverage of less than 2 times. In other words, for every dollar of interest expense that a company has to pay, they're generating less than $2 of cash flow. So that doesn't leave a lot of money for capital expenditures to sustain the business, taxes, working capital, and certainly not as a cushion in case things go wrong. So let me put that in some historical perspective. At this time in 2022, only about 20% of the universe versus nearly half today had interest coverage of less than 2 times. And you asked about signals that we look at. One more thing that I'll share with listeners that I look at as a leading indicator is rating agencies' credit upgrades versus downgrades. Again, focusing on the loan universe on a rolling 3-month basis at the end of February, there were over 4.5 downgrades for every credit upgrade from the ratings agencies. And again, 2 years ago, this was basically a parity, 1 upgrade for every downgrade. Now it's more than 4.5 downgrades for every upgrade. So as I look at these credit trends and I look at all of the economic uncertainty that's tied to these massive changes in economic policies and the deterioration in confidence that I think gets tied to these unpredictable policies, I think there's going to be a lot more to do in the credit opportunity space. So look, I don't want to be accused of being a grave dancer, but I'm actually pretty excited about the opportunity set that we're going to be seeing going forward.
Yeah, it sounds like turbulence is your friend if you want to get into this market. That's a wrap for my line of inquiry. Although we've talked about distressed debt, I've found it very comforting. It's been a great conversation, and I thank you guys for your time. And because you did such a great job, you do get the Alternative Angles parting gift, which is a coffee mug that I will be distributing to each of you soon enough. So thanks so much.
Thank you, Steve.
Steve, thanks for having us.
Thanks.
This podcast is intended for institutional investor and investment professional use only. Information presented herein is for discussion and illustrative purposes only and is not a recommendation or an offer or a solicitation to buy or sell any securities. Views expressed are as of April 2025, based on the information available at that time, and may change based on market and other conditions. Unless otherwise noted, the opinions provided are those of the speakers and not necessarily those of Fidelity Investments or its affiliates. Fidelity does not assume any duty to update any of the information. Unless otherwise expressly disclosed to you in writing, the information provided in this material is for educational purposes only. Any viewpoints expressed by Fidelity are not intended to be used as a primary basis for your investment decisions and are based on facts and circumstances at the point in time they are made and are not particular to you. Accordingly, nothing in this material constitutes impartial investment advice or advice in a fiduciary capacity, as defined or under the Employee Retirement Income Security Act of 1974 or the Internal Revenue Code of 1986, both as amended. Fidelity and its representatives may have a conflict of interest in the products or services mentioned in this material because they have a financial interest in the products or services and may receive compensation, directly or indirectly, in connection with the management, distribution, and or servicing of these products or services, including Fidelity funds, certain third-party funds and products, and certain investment services. Before making any investment decisions, you should take into account all the particular facts and circumstances of you or your client's individual situation and reach out to an investment professional if applicable. References to specific investment themes are for illustrative purposes only and should not be construed as recommendations or investment advice. Investment decisions should be based on an individual's own goals, time horizon, and tolerance for risk. This piece may contain assumptions that are forward-looking statements, which are based on certain assumptions of future events. Actual events are difficult to predict and may differ from those assumed. There can be no assurance that forward-looking statements will materialize or that actual returns or results will not be materially different from those described here. Past performance is no guarantee of future results. Investing involves risk, including the risk of loss. Alternative investments are investment products other than the traditional investments of stocks, bond, mutual funds, or ETFs. Examples of alternative investments are limited partnerships, limited liability companies, hedge funds, private equity, private debt, commodities, real estate, and promissory notes. Some of the risks associated with alternative investments are alternative investments may be relatively illiquid. It may be difficult to determine the current market value of the asset. There may be limited historical risk and return data. A high degree of investment analysis may be required before buying. Costs of purchase and sale may be relatively high. In general, the bond market is volatile and fixed income securities carry interest rate risk. As interest rates rise, bond prices usually fall and vice versa. This effect is usually more pronounced for longer-term securities. Fixed income securities also carry inflation risk, liquidity risk, call risk, and credit and default risk for both issuers and counterparties. Any fixed income security sold or redeemed prior to maturity may be subject to loss. Internal rate of return, or IRR, is a method of calculating an investment's rate of return, excluding external factors, such as the risk-free rate, inflation, the cost of capital, or financial risk. Global financial crisis, or the GFC, refers to the period of extreme stress in global financial markets and banking systems between 2007 and early 2009. Fidelity Investments provides investment products through Fidelity Distributors Company, LLC, clearing, custody, or other brokerage services through National Financial Services, LLC, or Fidelity Brokerage Services, LLC, members NYSE and SIPC, and institutional advisory services through Fidelity Institutional Wealth Advisor, LLC. Personal and workplace investment products are provided by Fidelity Brokerage Services, LLC, member NYSE and SIPC. Institutional asset management is provided by FIAM, LLC, and Fidelity Institutional Asset Management Trust Company. Copyright 2025 FMR, LLC, all rights reserved.